A recession is pretty much inevitable at this point. A lot of people are saying we're already there. But as we move into this new market and see the shifts in inflation and pricing and all the crazy things that are happening, is our real estate market headed for a crash, or are we just coming in for a smooth landing? The real estate market, like most goods sold, is a simple result of supply and demand. As supply drops, demand often increases, which puts an upward pressure on prices. When the flip side happens and supply increases, there's a lot more choices, so demand often decreases, causing prices to either flatten or drop. What started happening in 2022 was the federal government stepped in. So in lieu of just allowing the natural supply and demand to ebb and flow, they got involved and they started raising interest rates. And the reason they did it was to try to curb inflation, because with those really low rates, prices were jumping way faster than normal, and there was no way we could sustain that. Now, when it comes to supply and demand, what we really need to look at is the deficit of supply that we've currently got in the nation. What we need to consider is that we are actually down 5.5 million homes. Yes, we are short on almost 6 million households from where we should be right now. And to combat that massive gap in supply and shortage of homes, what the feds did is they went after the demand side of the equation. Rather than trying to figure out how to increase supply, they wanted to tap down on demand. And they did that by increasing interest rates. What we saw is over 2022, rates almost doubled in the span of just 12 months. And that effectively took a lot of buyers out of the market and started bringing demand back down. The problem with this, though, is not only has buyer demand dropped because of the raising rates, but supply also has dropped a little bit with it because of the mortgage rate lockdown effect. What the mortgage rate lockdown effect does is essentially less houses are coming on the market to help with the supply issue, because current homeowners who bought their house in the past and have a rate less than 5% are not really likely to sell their current house to go buy a new house at a much higher rate. What we're seeing right now in the Alachua County area is prices are actually up 8.3% from this time last year, and inventory has actually increased from 1 month this time last year to 1.8 months. But if you compare just to last month, inventory has dropped a little bit. And that, friends, is what happens when rates go up. People who would normally sell and either downsize or upsize to something tend to hold tight because they don't want to pay that higher rate. And you can actually see that in our local area, because compared to this time last year, new listings are actually down 31% right now. And the average days on market from when the sign goes in the ground till when it goes under contract has gone from 19 days to 44 days. And some new inventory is coming out on the market because regardless of rates, regardless of prices, regardless of the market, people do still have to sell. Sometimes it's a job circumstance, health related, family related. There's always going to be sales in any type of market. So what does the Fed do next? The first thing they can do is they can keep raising interest rates. That would be very effective in quelling the buyer demand that we're seeing right now. If rates shot up to 7, 8, 9%, some people would still be in this market, but a lot of people would pull back. The problem is if you pull the average buyer out of the market, you just create space for investors to scoop everything up. And then they're just gonna rent back the houses that people should have been able to buy themselves. So it's kind of a tough position to be in. The second option would be to do the flip side, which would be to decrease the interest rates. Now, we're starting to see more buyers enter the market because many people have gotten over the initial sticker shock of seeing a 5 or 6% rate. So if all of a sudden rates dipped below 5, I think we would see a massive surge in buyers. Now, it would be a great way to get buyers back into the market, but because we have such a supply issue, it would take us right back to a year or two ago with massive price increases and double-digit price appreciation that we just can't sustain. Option 3 would be to sort of keep rates flat and stable and hopefully buy builders more time to beef up the supply. With the massive deficit that we have, though, it's kind of a tall order. It's going to take years for the supply to catch up. But by keeping rates somewhat flat and stable, that's probably the least volatile solution to today's market problem. In the meantime, a recession is inevitable, a lot of people are saying it's already here. However, with supply as low as it is and still a healthy buyer demand, I just don't see there being any major crash coming. Unless the Fed does something drastic, I'm predicting a nice soft landing for this new market. And we have a ton of data to go off of, and we have some past mistakes to learn from, because by looking at past recessions, it can really help in seeing what we can possibly predict for the future. I'm Lindsey Johnson, your resource for all things real estate. See you next time.